Remember when you used to do maths at school and you used to do lots of examples? Well, it's a bit like that. We really need to see more of these trades to get this in. So let's say we're looking at Anglo-American, and let us say that's the last price bar we're looking at. Well, obviously we're not going to get in, because look at what the MACD is doing. It's falling sharply, so we still think the stock's going to fall, so we don't do anything. Actually, it doesn't fall that much. The next day it still stays within the previous day's trading range, but the MACD is still going lower, so we're not interested. On day 4, it cracks and it moves and it makes a new low. So we were right not to have gone in. Then we fast forward to day 6. We see, that's interesting. Okay, we're seeing how the stochastic and the RSI are sort of bobbing along a bit. But nothing much happening because the MACD is not giving us anything decent to work with. But it is now on day 7. What's happening here? So we've been monitoring this stock. What's happening here is that we've just got not only that spike, but we've got the MACD starting to rise upwards. The stochastic at a higher point than it's been for a while, broken through this 20% barrier, so it's gone from oversold, broken through its %D. And like I say, highest point that's been for a while, confirming MACD as well. So we think to ourselves, okay, we might have a base which has been formed here, from which the price will springboard and go up. Another way to look at it is, price has done this. Now what we think is it's going to continue doing that, as opposed to doing that. So, fine. Stop loss. Oh, that's easy enough, because if we're right, the price shouldn't go down there, which is 30 points lower. Entry point next day, if it breaks the preceding day's high. 35 on the low side, therefore we need a profit target of at least 12.30 on the upside. Well, I think 12.30 is achievable. Indeed, 12.80 might be a secondary target for us. So let's see what happens. Day 8, the very next day, the price does indeed rise. We do get in, we get confirmation. MACD nicely broken its signal line, so that's a bit of a relief there as well. Stochastic rising, RSO rising, all is well with the world. And we probably would have put our exit stop loss a bit higher as well, moved our stop loss up, our trailing stop. Day 11, so we're moving forward. Now we're getting sort of slightly different. We're getting a bit of petering out. Well, okay, not too bad, because we've hit 12.30 or 12.30-ish, so we'll have got out at some level if we wanted to, but we still got the MACD rising, and it's not got anywhere near this range, so we're probably going to stay in for now, even though the stochastic's overbought, because we expect the MACD will overrule it. So what happens? Day 12, the very next day, yes indeed, we get a slight rise on the price, confirming all of this. So what we're hoping for is that we'll get a bit of, it's formed a bit of a sideways base in that time. Now it's going to go upwards, hopefully. What happens next? No. In actual fact, the MACD goes sideways because we've had this big dip, moved up again. So now we're getting worried, and now we're thinking, okay, pushing our luck maybe a little bit, stochastic's dropped off a bit. Let's think about exit levels now. As I said, 2-day low, 3-day low, whatever it is, or exit half a position now, half later. So, going forward, we're getting very close to an exit level. What actually happens the next day? Yep, not good. We don't make a new high, and we make a new low relative to the preceding date. Time to exit, because not only that, the MACD is going sideways, and we see then on day 16, yet again, more weakness in the price trend. The MACD arguably going sideways there, but the price confirmation fairly weak. Hopefully we've got out half our position at the very least, if not all of it. But if not all, because we're still thinking let's hold on to this MACD, after all the stochastic's risen a little bit, then fine. We didn't get out all of it at that point, and we stayed in and maybe got out the rest of it later. Overall, should have had a bit of profit from our original entry point. Our original entry point, which was about 11.95. In that, we hopefully took some profits out at a point above it. What was disappointing is we certainly didn't, unless we got out right at what our profit target we'd initially set ourselves. We may well not have got out at what we wanted, which was up there, and we might only have made very little money from our entry level than we would have liked, despite having called the trend right. And that's the nature of the beast, because unless you decide that you're going to have an initial profit target, or if the price, you put a very tight stop, like for instance, if the price fails to make a new high, the next day you will exit. If it makes a new low, then with that kind of rule, you wouldn't have exited there, not here, not here. Here it fails to make a new high, and you'll exit if it makes a new low relative to the previous day. Well, you probably exit on this day around here. Fine, you got out at about 12.20 in that case. But if you had a rule which was I'll exit on a 2-day low, then chances are you probably would have got out closer to this or even this. The point I was making is, depending on how tight our exit rules are, we do have a trade-off between getting out too early and getting out too late and missing some of the extra profits. Equally, one of the ways we alleviate this is we only exit half a position at one of those points, and we play around depending on how strong we feel about things. You know, it might be that around this point we wanted to put a tight stop loss because we felt the news stories had changed against commodities, or it might be that we wanted to put a very loose stop loss, and we did what we did, and that so be it, because we felt that this was likely to resume upwards yet again. But this is just to show you some of the discretionary element part to it.